Thank you for tuning in to our Retirement Education Center YouTube channel, where on this channel we believe in providing you unbiased advice that will help you maximize all of your retirement income. Now, on our channel, we do not believe in providing you any type of silver bullet strategies, and we certainly do not believe in glorifying any type of one product. But what we do believe in are holistic concepts that will help you retire with confidence. Now, I believe that due to the insolvency issues, Andrea, with Social Security and Medicare and other government-funded programs, that I think most of us are in the mindset that taxes are definitely going to be increasing for everybody over a period of time, maybe even doubling for some people. But Andrea, if you're able to do some careful planning with a proper and intelligent financial advisor, you might be able to give yourself a competitive advantage in the future. So that's what we're going to be talking about, how to make sure that you can understand the ability to actually have a better retirement income tax situation. So stay locked in. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Yes, because with so many retirement concepts out there, so many retirement strategies, and of course with so many retirement products, it can certainly become very difficult for consumers to digest all of that. That's why we're so fortunate that we're able to work with a team of expert advisors to help us formulate a roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, now no one can completely escape taxes during retirement, but you believe they can be controlled or mitigated, right?
I do, Andrew. Just based off of my experience in my practice, I absolutely do believe they can be controlled and mitigated. And when it comes to compromising, Andrew, that's pretty much the way it is with anything in life, right? Everybody has to have a proper compromise. It's been said that a good compromise is when everyone feels like they didn't get enough from that deal. And so the same will hold true for taxes when it comes to your retirement income. Uncle Sam is going to want more, and you're going to want to give Uncle Sam less. And usually you're going to have to probably meet somewhere in between in order for everyone to actually be satisfied. So that's what we're going to be talking about today. Ways that you can think about your retirement income taxes in a way that will give you more of the advantage than Uncle Sam. But before we get into that, there are two rules to retirement income that we like to share with you. And Andrew, what are those two rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
Okay, so let's go ahead and jump into our lesson today to talk about retirement income taxes.
All right, Carson, what is the tax trap that most people will find themselves in?
Well, Andrew, when it comes to your retirement and from a tax perspective, there's usually 3 buckets that most people focus on when it comes to those particular dollars. The first bucket is usually the bucket in which you're going to be taxed right away on. It's your taxable bucket. You're going to receive a 1099 from this particular bucket. It's going to be things like your brokerage accounts, your CDs that are non-qualified, cash savings, money market accounts, things that you typically would keep as liquid, where you may have anywhere on the low end from 3 months to as high as maybe a year of savings into. That particular bucket, of course, is going to be your taxable bucket. And I think most people would agree that there should be some amount of dollars allocated towards that particular bucket in the first tier. Now, the second tier bucket is the one that usually gives more people a cause for debate, and that's the tax-deferred bucket, okay? Now, the tax-deferred bucket is going to consist of things like your traditional IRAs, your 401ks, your 403bs, your 457bs, your simple accounts, SEP accounts, if you have them as a self-employed person. Now, those accounts are going to be tax deferred. Basically, you're kicking that tax bill down the road for a later date. Now, Andrew, if you feel like you're going to be in a lower tax bracket down the road, this may not be such a bad idea, because these accounts have 2 things in common. One, the amount of money that you put away can be tax deductible from your income. And the second thing they have in common is that when you take that money out, that money is going to be taxed at your progressive ordinary income tax bracket. So basically at the highest taxable rate, unlike the other buckets, which may be taxed at 0 or maybe as high as 20% at most. So this is one of the things that you're going to have to consider. When you take that money out, am I going to be in a lower income tax bracket on the back end? But when it comes to the tax deferred bucket, Andrew, that's really not where the story should always end. Because even if you think you're going to be, or maybe you perhaps will be, in a lower tax bracket on the back end, depending on how all of your other income sources are counted, when you're mandated to take money out of this bucket, and you will have to take it either at age 72, maybe age 73, or even age 75 now, when they mandate you to take these dollars out in the back end, Andrea, that money, as I mentioned, is going to come out at your ordinary income tax bracket, and it's going to be included in your provisional income. What is provisional income? Provisional income is anything that you have coming in as a form of income. Interest, dividends, capital gains, royalties, rent income, tips, wages, anything of that nature, plus, Andrew, 1/2 of your Social Security benefits. So just imagine that when you have deferred all of this money on the back end of your retirement, and now that you're mandated to take this money out, and it pushes you into a higher tax bracket. Well, if you are single and that pushes you in an income bracket above $34,000, up to 85% of your Social Security benefits can become taxable. If you're married filing jointly and it pushes you over $44,000, which a lot of people will fall into, of course, up to 85% of your Social Security benefits can become taxable. And beyond that, if you're receiving your Part B and your Part D, if it pushes you into a different income tax bracket there, you may have an additional surcharge on those premium dollars that you're paying. So you really have to think about how to manage that situation, Andrew, when it comes to your tax deferred accounts, even if you believe or know that you're going to be in a lower income tax bracket on the back end.
Carson, it seems like most of these options that you mentioned have both pros and cons to retirement to consider. But the last bucket is the one that you feel provides the most benefit for securing a tax-friendly retirement.
Yeah, and this last bucket is absolutely the one that I feel can provide, most retirees the best advantage when it comes to the retirement situation, because that's the tax-free bucket. So obviously we talked about the taxable bucket, the tax deferred bucket, and now we're talking about the tax-free bucket. Now, when it comes to being tax-free, Andrew, there are a couple of things here that must apply when it comes to me seeing a bucket that's truly tax-free. One, any income that comes out of this bucket, Andrew, cannot trigger any type of federal taxes, state income taxes, or capital gains tax. That is one of the elements that needs to be known if you're going to be operating from a tax-free perspective. Another point that I want to make on having money that really is tax-free is that it also cannot be added to provisional income. As we just mentioned, anything that's added to your provisional income can cause other things to be a disadvantage to you in your retirement, like increasing your Social Security benefits and giving you that surcharge on your Medicare Part B or Part D. And of course, Andrew, one of the most popular, products that people are going to implement for their investments when it comes to tax-free status is a Roth IRA. Because a Roth IRA, the money will go in after tax. The money would be allowed to grow tax deferred, and if you follow certain rules, like taking that money out after the age of 59.5 and making sure that it's been in there for at least 5 years, all of your distributions from that particular Roth account will come out tax-free. Another important element, Andrea, when it comes to a Roth distribution is that it will not trigger any type of provisional income. So Roth distributions are not, I repeat, are not included into your provisional income calculations. Therefore, you will not have any negative effects on your Social Security benefits and perhaps, creating any type of surcharges on your Medicare Part B or Part D as well. Another notable tax-free account that many people may overlook if their employer is offering it is an HSA account, a health savings account. Now, this particular account, Andrew, enjoys maybe one of the best taxable situation of any account because the money can go in pre-tax, meaning that money can be written off from your retirement income, just like you do when you're putting money in your 401k. The money inside of that HSA, Andrea, will grow tax deferred, meaning it'll grow tax free. And when you pull money out of an HSA account for a qualified medical expense or reimbursement, that money will come out tax free as well. So you have 3 tax advantages when you're utilizing an account like this. So this may be another element that people should make sure that they think about if they have the opportunity to participate in one. And one final tax advantage product, Andrea, that people fail to understand is permanent life insurance. Yeah, I know. I said it. Yes, permanent life insurance. I don't know why people get so up in arms about things that can actually take care of them, like annuities, which can provide you a lifetime income, or permanent life insurance, which can go to your estate tax-free. So if you have an estate issue, there's nothing more cost-effective than doing a permanent life insurance policy. Plus, the income or the money that's inside of that permanent life insurance that you're building up, the cash value, you can actually take that out tax-free as income through policy loans. So, of course, this can be an advantage for anyone when the market is actually going down, like we're seeing now, and perhaps they need income from their portfolio, but they don't want to take that money out at a loss. So guess what you could do? You can actually reach into your permanent life insurance policy and give yourself a bridge, a tax-free bridge that will not have the elements and the effects of a down market to secure your income until the market actually rebounds. So that is just a smart strategy, and you simply just have to be educated with a proper advisor who is a fiduciary that will not just sell you a product, but will allow you to have a product aligned within your plan so you can actually take advantage of these types of products. Another major concept from a permanent life insurance policy that people may not think about as well is that it can actually kill 2 birds with 1 stone. So let's say you're not in need of the death benefit right today. Obviously, if you're alive, you're not needing it now, but you have a long-term care issue where you can pull from that death benefit to actually take care of some of those long-term care issues tax-free as well. So you're talking about a major advantage with one product that many people really don't know how to use, or they have been told the wrong thing about the particular product itself. Remember, trust the plan, not the product. Get educated so you're not frustrated when it comes to these different situations.
Well, Carson, I really appreciate that information today. So thank you for your insight on this topic. And thank you for watching. And if you feel this information was beneficial for you, please like this video and share with others.
So I really do hope that the information that we shared with you today will be beneficial in helping you understand the different concepts of how to reduce the taxation on your retirement income in the future. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.
For more information about this topic or any of the other topics that we've created in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.